This episode, as with all episodes, exists thanks to the supporters of the show who contribute a mere $3 per month via patreon.com/Copytraders Club. Thanks for listening, and thanks for your support. Copytraders Club, where you can learn how to make better decisions and more money copy trading. I'm Gavin McCauley, my name and username on eToro. Today we welcome a trio of big names to chew over some of the hottest issues of the day in the eToro-verse. Here we go. Season 2, Episode 30 of the Copytraders Club podcast, and as always, my aim as an eToro enthusiast is to demystify this new and uncharted world of copy trading, understand what are the pitfalls and best practices, and how ultimately to succeed as a copy trader. In chats like today's, we treat you to a roundtable chat with some A-list guests. This episode is divided into 3 parts. Part 1, time for a feed. We dissect and digest the eToro newsfeed. Is it a bit off? What are the best ingredients? And will eToro's initiatives be the icing on the cake, or are the chances of a quality newsfeed toast? Part 2, when will copy mean copy? There is talk that copy trading will soon be based on the value column and not the invested column. This means when you copy someone, you will actually have what they have, which is what most people understand by the word copy. If true, this may correct one of the more perplexing elements within the system. But what are the limits to the benefits this will bring? What will the possible knock-on effects be? And does everyone even agree it's a good move? And part 3, will this conversation ever pay dividends? We consider dividends on eToro. What are they? How are they treated? Is it free money, baby, or a marketing ploy for suckers? Or somewhere in between? What are the right ways and the wrong ways both PIs and copiers act in regard to dividends? 3 excellent topics, and we have 3 stellar guests to address them. So let me say hello to you and to them as we get cracking. Hello listener, and welcome to the first roundtable episode we've had for a while. And what a good looking panel we have today. A sweet slice of Danish that is everyone's cup of tea, Christian Kongsted, aka CPH Equities. Hi Christian.
Hi.
We welcome the hottest guy on YouTube, a man that we all follow, Andrew Haddon, aka FelixFallax. Good day to you, Andrew.
Great to be here, Gavin, for what I think is my 5th appearance on the show, but who's counting?
You are, evidently. And redressing the testosterone imbalance, we delight in the graceful presence of Neza Molk, aka Nezatron. Welcome, Neza.
Hi, thank you for inviting me.
Okay, so I'm guessing Christian and Neza met in London at the PI conference. But Andrew, it's your first time meeting these 2 high-profile PIs, right?
That's correct, yes. I've enjoyed getting to know them in the green room, in the palatial surroundings of the Copytraders Club lounge just before we've started broadcasting.
And I'm sure they're both big fans of your channel.
I am.
Yes.
Someone's going to say, who? What channel? YouTube? Okay, so let's get on with it, guys. Part 1. At a time when all eyes and ears of the investing world are on the Fed, we will be adding an E and examining the feed, the eToro newsfeed, possibly something much closer to home for those of us who concern ourselves with the goings-on on the platform. So to set the scene, eToro promotes itself as social investing. You sometimes hear comparisons to Facebook or other social media channels where people share their thoughts Others contribute, and it becomes a free marketplace for intelligent, investment-related debate. A stimulating smorgasbord of diverse and informed opinions. Does that sound like the eToro newsfeed to you, listener? Is that what you think to yourself as you scroll down the newsfeed on eToro? Do you scroll down the newsfeed on eToro? That very simple question might be a place worth starting. Let me talk to everyone here and put that question to them, starting with Neza. Do you scroll down the newsfeed on eToro?
I do check it sometimes, but I like to scroll it through, but I rather go to tickers, to specific tickers, and read posts about some analysis or so. Sometimes you can find a really good post, but yeah, it depends.
Is your experience similar, Christian?
Yeah, I would say so. I don't use much time on the feed, but like Neza, I find it interesting with something very specific, if it's a specific company or if it's a Forex pair or something, to see what other people are analyzing in this specific pair. So it's not the feed as such, but more like going to specific tickers or currency pairs or something like that. So I think it's good that it's a social network, but obviously it's something that could be done much better.
I really like reading posts from other PIs that invest in similar companies and their thoughts about them, because those posts are most of the time really quality, and I like reading to those.
I think that's something we can all agree with, and I suspect our conversation is going to be more around how can we highlight the quality and remove what's dragging it down, perhaps. But before we do, and before we get on to Andrew, if the listener can picture being on their homepage, just above where it asks the question, what's on your mind, to elicit a latest post from you, there's a bold header that says newsfeed with a drop-down arrow. When clicked, that arrow gives you the option of number 1, newsfeed, number 2, public English newsfeed, number 3, saved posts, and number 4, popular investors. What do we make of these filters? Maybe Andrew, you could speak to this. Are those filters effective, useful?
Well, first of all, I'd say I think the newsfeed is an excellent way of getting the opinions of the people on eToro, which really complements the financial news like Market Watch and MSN Money, which I've checked daily for years. So that is useful. And I think it was good that eToro added the filter that you could look at only popular investors posts. And one of the things you would expect that to do would be to filter out a lot of the spam, which you'd maybe expect from non-popular investors. But as we'll probably talk about, unfortunately, I'm finding an increasing amount of spam coming from actual popular investors. So it doesn't necessarily do the job that I'd like it to do. And maybe it's not customized enough in terms of I'd like to see popular investors who I'm following, but not necessarily copying, which I can't do at the moment because on my FelixFallax account, for example, I'm not copying either of the two guests you've got on the show, but I'd really like to read their posts. So I have to remind myself to actually check their posts regularly. There's not really any other way of me being alerted when they post.
Well, that's exactly one of the main points. The next point I was going to ask is, what's the point of adding someone to a watch list? What does that do in terms of notifications and the feed? Nothing really. So wouldn't it be great if there was an active follow button on each profile so you get notifications from those you want, and there's a newsfeed filter showing followed so you can see the feed from all of those that you follow? That would be perfect, would it not?
I think so. I think also that the main thing is that the algorithm, like if you look at social networks like Facebook, TikTok, and so they're famous for the algorithms for optimizing relevant content. That's actually the reason why TikTok have been doing so well, because they managed to put the relevant content on your feed. And I think one very simple way of doing this is also to focus more on what content that creates engagement, which is what Facebook does. That's the very simple way. Just looking at what posts actually get likes, what posts are people interacting with, commenting, and so on. because in the eToro feed you only just get the latest of the latest news. So it's someone who has posted within the last hour or so, that's going to be in your feed, and also then you have to scroll back and so on. But then if you look at Facebook or LinkedIn, for instance, then you would see posts that's actually like 24 hours old, but you see a lot of people interacting with it. And that's a very simple change. I'm not saying it's easy, because I'm sure it's on their to-do list. I'm just not sure where it is on the to-do list. But that's something that most people that have been working with the web realize that having an algorithm that's a bit more advanced, just showing you content, would be a high priority. And I think for eToro, it would also make a lot of sense business-wise, because if you make the feed more relevant, people would stay much more on the platform. They would trade and invest much more, I think. And right now, the feed is not helping so much, I think. I mean, it's still better than almost anyone else out there, because they don't have social networks. So I think it's the right thought, but it hasn't been improved for many years. And I think now is probably the time to do it.
I agree with Christian at this point, and I think that with this feed would be more personalized, so you would get more posts that you are actually interested in them. Like he said, posts that has been on eToro for more hours, but you only see the recent ones that are not that interesting to you. And maybe also for PIs, it would be better, since you would get more engagement, more likes and more comments from people who are not reading your posts and looking at your profile every day, because they would see it on the feed.
And surely it's not too much of a stretch to consider categories of posts. You know, if you're going to write a review on a stock and present the bull case, you click a little box that says that this is a thesis post. And then you can see we all know examples of websites where you can put in a ticker and see various theses. Surely that would be a great thing for eToro to have, and you can read through what various people have to say, bull and bear cases.
Yes, I think that's one of the problems, is that there's some really well-written articles with a very well thought-out thesis, which might have taken someone an hour to write or even longer. And that's just getting the same level of prioritization on the newsfeed as a simple Dogecoin up or down post, and sometimes even gets fewer likes, which is quite disheartening. I certainly think that I try and write thought-provoking posts, and a lot of the people I follow also do that, and it's quite disheartening to see them getting just 1 or 2 likes, and it doesn't then encourage them to invest the time to write similar posts. So ideally, I'd like to have a feature where you could kind of give a post, I'd like to see more of this, or I'd like to see less of this, and then eToro's algorithm personalizes it towards you, as well as what Christian was talking about, an overall algorithm where the post that gets the most likes end up getting escalated higher up on the feed, even if they're a day or 2 old. It would also take away the problem of people constantly resharing posts, because that would already give them priority.
A similar but slightly different point, which is connected to what I asked about adding someone to a watch list, is that the notification system, my notifications, and I'm sure it's true of all of yours, are overrun with messages that others have commented on a post that I commented on. I make the mistake of commenting on somebody's pinned posts, and then my life's a mess for the next 4 weeks. What's the point in that? They're completely pointless and annoying. Surely at most you should get others have replied to your comment. If they're going to prepare to answer my comment specifically, okay, I'd like to hear that. But not every Tom, Dick and Harry's opinion.
Another problem with that is I think that there's a feature to disengage with it and to stop notifications for this one. I don't think that works properly at the moment, because there's been several posts where I've selected, please don't notify me, and I'm still getting them. So I think there is a feature that wouldn't completely solve what you're talking about, but that isn't working properly at the moment. But ideally, yes, you might have levels of it where it tells you every single comment someone's put, or it just says 10 people have commented on this post today and sort of distills it, or the option to just get no notifications whatsoever. Whereas at the moment, you're just getting, as you say, hundreds of messages from something you commented on weeks ago that you're not interested in following that conversation anymore.
Can we agree that it would be good to disable the share feature for every trade?
You mean after you made a trade, you can share the trade?
Yeah, I mean, because the feed is full of people saying, I just closed a trade and made 5% on Apple. So, okay, yeah. Great. How does that improve my life?
I think it's some of the features are some features that has been there for a long time. And I think I remember seeing this many years ago, and it hasn't changed since. But the thing is that eToro has actually changed a lot since then. So it's a different platform now, but some of the features from that time is still there. And for this reason, I agree. I think it's not something that helps you very much. I'm not interested in seeing those posters at all.
I think it's good if used in moderation. Like I'm looking at Nezatron's feed just now, and she made a post saying she'd closed an Apple trade for 54% profit. But that was a long-running trade. That wasn't just like a daily thing that she's doing. That is actually, you're explaining why you've closed it, and you might come back in later. So I think if that is done properly, it has value. But it's if people are every single day, I've closed a trade at 1% profit and just spamming the feed with that, obviously that's when it becomes a problem.
I just wanted to say that because I think that if you are explaining why you closed or opened one trade, especially if you're a PI, that might be interesting for all of your copiers and followers. But if you're just randomly posting each of your trades, it's actually spamming the feed.
Exactly. And it's where you draw that line. It's kind of a subjective thing. That's the issue that eToro has to really navigate.
And while we're on the subject of what PIs posts, Andrew, I know you've got a lot to say about the quality level that PIs should be held to in terms of what they put on the feed and what value it adds. Would you like to dip your toe into that area?
Okay, I was thinking before this what I would consider the perfect PI post. I think it would have 4 elements. First of all, be educational in some way. And it doesn't mean it needs to be long. It could even be just someone saying the Pelosi family have sold their shares in NVIDIA a few days before it crashed in value. And it could be just short like that, something educational, something that's erudite and well written. That means not plagiarized. And something that's entertaining, like Lizia Pukaya. I know he's been on the show. He posts really funny stuff. So I think that's good, again, in moderation. And self-promotion is fine, but I'd rather it was of the form, now you've read my post about long-term investing, why don't you take a look at my portfolio and consider copying me if your values align with mine, rather than just saying that self-promotion bit and missing out all the rest. So that would be my perfect PI post. And unfortunately, as you're saying, what we're seeing is things like tagging high number of assets, more than the 5 permitted, resharing the same thing or just posting the same thing 10 times per day, sharing your own post via your primary account or even a secondary account, inane or crass posts like sharing your account balance daily, top market movers, every single stock that's paying a dividend, pre-market prices, how much you made in the last day, etc. And also, finally, just to close that, is misinformation such as basically lying about your performance or exaggerating it, benchmarking yourself against something that's completely irrelevant, or exaggerating your dividend yields. So that's what I don't like to see. And what I would like to see is these kind of well-written, well-thought-out posts. Everything's fine in moderation. I appreciate not everyone can do that or has the time, but it's just went too far towards the latter in recent weeks and months.
Well, evidently eToro are aware that the feed needs improving, and they've recently launched an initiative to try and improve that, which I'm sure most people are aware of. eToro have launched an initiative to reward cadets and champions who contribute posts that are considered among the 15 best per month. And there's a super duper cash prize of $1,000 for each of those 15, I believe. I'm very excited about this because should I be in either of those categories, obviously any post to the latest episode of Copytraders Club is highly likely to be among the 15 best that month. So I'm going to be rolling in it. What do we think are going to be the effects of this?
I think overall it's a good thing to promote good content. So probably you will have more people trying to create good content. The key point here is how is it going to be measured, what those posts are. And what I've heard so far is that it's going to be an automated way. It's not going to be eToro judging this discretionary subjectively. It's going to be some kind of fixed value. Let's say the way that people engage with the post, the number of likes and comments and so on, the number of shares or whatever. I'm not sure exactly what it's going to be, and I'm not sure if anyone knows this yet, except for eToro. Maybe some of you guys know, but I guess the point is how is it actually going to be measured? Because the point is that you could have people, let's say that likes and engagement is an important point. Then you would have people maybe doing like hunting post, or maybe doing some funny meme or something, and that may be a good post, but you would have to monitor this very closely to see if it actually creates better content on eToro. I think overall it's a good thing to make this experiment, and we'll see how it turns out. But it depends a little bit on the implementation.
I think that it should be that everyone should post a quality post, and I think that eToro is trying to encourage that with this initiative. But I am afraid that I also gave back my feedback to eToro. So I said them that I hope that we won't see less and less quality posts because of that. And as Christian said, I also don't know more about how they are going to measure quality of a specific post. And I think that when you are a cadet or champion, you are already trying to get the more feedback, more likes, and more shares. So I think that cadets and champions, at least some of them, are already posting a lot. So we will see what happens.
Yes, I didn't know this about how it was going to be measured, but I guess it could go two ways, and people might try and post better quality posts. However, obviously, if it's done by the number of likes, for example, that's rather open to abuse. Maybe a hybrid approach would be ideal, of where eToro have the top 50 posts based on likes or the other algorithm characteristics, and then a human being actually reads those 50 posts and decides which of the 10 best ones or 15 that they think are the best written, because otherwise you could get having like a cat meme or something could be the top post and get $1,000, and everyone else then might think, oh, it's a great way to get $1,000, and start spamming the feed with similar posts. So it could go either way, but it's an interesting idea of paying people for the quality of the writing and how they're engaging with the community rather than their ability to attract copiers. Although the two are somewhat interlinked, I guess.
Well, Andrew, you're famous for shining a light on the practices of PIs, not all of which are whiter than white. Your mind must go towards areas of potential abuse of this system. What sort of PI skullduggery could there be in terms of trying to engineer likes and shares and things?
Oh, yes, I guess it's just a variation on what's going on at the moment. Is it would be like just throw as much at it as you can and see what sticks, like post 300 or 400 times per month and hope that one of them goes viral, and then that would win the 1,000th award. That would be one potential way to abuse it, so to speak. And that would also have the effect of kind of wiping other people's posts off the feed, which means other people's are less likely to get likes because no one will actually see them. It's hard to say, though. I mean, I think with anything, you can try and model it, what you think human behavior is going to be, but when you actually put it out into the wild, it could surprise you in a positive or a negative way. It's just like everything with the PI scheme, I guess. Things have been tried, and then after a while, maybe it's decided that's not working that well. Let's say risk score or whatever was changed from 6 to 7 recently. So you always have to look at how well something's working, and if people who are trying their best to do a good job are not being rewarded, and people who are up to their tricks are being rewarded, then obviously you have to refine it in some way. But I guess it's a good starting point of saying, what did you say it was, top 15 or something every month, get $1,000, see how it works out. And if it just ends up not working out as well, then you can change the parameters around a little bit and see if you can improve it.
I'm reminded of something I saw on your channel once where there are like networks of people who are all scratching each other's backs. And I can imagine something like that being at play here.
Yes, that's a good idea, actually. That we've just given people an idea of how to scam the system. That could be people working together or liking it with their second accounts. Not that any PI would do such a thing, is using their second account to share or like their own post. And other people in some sort of network and saying, right, I'll split the money with you, give you $100 each if you all like and share my post. So yeah, that would be a potential way of abusing it. So thanks for suggesting that. Now everyone will be off to do that.
Okay, coming up in part 2, when will copy mean copy? So part 2, when will copy mean copy? A couple of little birdies tell me that a big change is coming. That copying will be based on the value column, not the invested, which sounds on the face of it like great news to me. By the way, neither of those birdies is present in this conversation, for the record. But that's going to have a lot of knock-on effects. So can we sit here and rub our respective chins over what this will all mean? Can we fully explore the benefits for both copiers and PIs? What are the limits of it? What does it not change?
Yeah, I can say that overall, I think that this is a welcome change. I mean, if it happens, because it's not confirmed yet, of course, but I heard the same rumors as you. So I think it's a good change overall, because it's difficult for most people to understand why the system is like this, that the way it is now, where if you copy someone, it's actually, I mean, maybe we should explain it like if I buy 1% of Bitcoin and then it doubles, then I have 2% of Bitcoin in my portfolio. But when anyone copies me, it's going to be 1% as I originally invested in Bitcoin. That's really confusing to a lot of people. And even when people understand that this is the case, and I think most of people doesn't know this is how it has been working, they almost like they don't want to copy. And actually, I wanted to copy myself on a second account, but I've been waiting for this change to do it. Because if I was copying myself, I wouldn't get exactly the same proportions. So now I just made a big maneuver where I sold everything and I bought everything back again, because then I have the right proportions for my copiers. So in this moment, the proportions are almost right. So now I can copy myself if I wanted to. But the thing is that it's just something. This maneuver, it took me several days, and actually eToro crashed at this point. I don't think it was my fault, but there was like several hours where eToro was not working while I was doing this rebalancing with the eToro team. And so it took me several days to make this rebalancing. And I think I had like 100 questions about why was I doing this? Why was I selling all of those positions? Some with a loss, some with gains. People had a very hard time understanding this, and this is something that hopefully we will get rid of when this change happens. So I welcome this change because I think it's the most intuitive way of copy trading to work. But I would be happy to hear your thoughts on it.
So I have to say that I'm more on this invested side because I invest on a long term. So it kind of doesn't make sense to me, since closing any of the positions because there's too much exposure makes no sense to me actually. For example, if one of my copiers enters when, for example, Meta, which I invest in, is at lowest value in my portfolio, and it sometimes it goes right after a couple of years that I'm investing in it, then I would have better results than them. And last year in November, for example, Dale, one of my companies that I invest in, had a spin-off. And because of the spin-off, I am around 40% in minus. So that would also be a problem for one of my new copiers, for example.
Okay, that's interesting. I would have thought that long-term investors would have been the most happy about this change. Because if you're going to buy something and hold it for years, it gives rise to the potential for huge appreciation of the position. So if it's 3 or 4x'd, you want copiers to join you where you're at rather than where you once were many years ago.
But I designed my portfolio that each of positions that I have a desired percent invested in, and for example, 5% or so. And if it increases, if someone tries to copy me and then invests, for example, 10% in one position, but I originally have only 5 because I wanted to have 5, it won't be the same. So I see an issue here.
I've got a question I would ask Neza, is if you consider your invested column to be the optimum portfolio, then does that not mean your current value is a suboptimal portfolio? Therefore, what you're actually holding at this moment is not your desired proportions. If that makes any sense. I can explain it in a different way. Is if you mentioned that, say if you bought 5% in Meta, for example, and that dropped to 2.5%, you're saying you'd like copiers to have 5%. So that must then mean that you don't consider yourself to have enough Meta in your portfolio because you think 5% is the optimal amount of Meta that someone should hold in their portfolio at this moment. So I would be on the side, I guess, of Christian of saying that it's what we're holding now that's the main thing, because that's going to dictate the future results, not what we used to own. However, I also get the point in the Meta example I just gave. You could come with the argument of saying that it's really undervalued, so new copiers should actually be investing more than you've got at the moment because it's cheap, so they should be buying 5% of it. I can see both sides of the equation, and it's a good point you made about this could be a potential downside for people who prefer the invested amount, which you obviously do. And I think there are some people that possibly would have the same mindset as you. So, yeah, I had suggested to Gavin that maybe they could have a tick box where someone could choose to copy the invested or value, but and last time I spoke to him, but kind of felt that was confuse people even more. So it's definitely a big thing eToro have got to decide one way or the other.
So let's think about the things that it does change. Desynchronization is obviously something that's going to be affected to a considerable extent. There's still going to be some desync. It's not going to go away completely because for various reasons, copying with insufficient funds, copying open trades or not, jurisdictional issues, copiers closing certain positions.
Also PI deposits as well. Unmatched deposits by the copier would create desync under the new system as well as the old one.
Sure. But the main cause of desync is kind of going to be removed, is it not?
Yes. Yeah, well, the main cause of desync is what Neza and Christian would both acknowledge is that when you copy someone, you're getting their original allocations rather than what they've got now. So you don't have the same portfolio as them. In some cases, there's been people who bought 10% Tesla and have now got 50% Tesla. So you're getting 10% and they've got 50%. So your results are going to be totally different from theirs. Could be better, could be worse, but ideally you'd like to have the same portfolio as the person you're copying. So when they're making decisions, presumably for the benefit of that portfolio, it's going to benefit you both equally rather than them managing one portfolio and your portfolio is totally different to the one that they're managing, which creates a bit of a conflict of interest if they're too far apart. But certainly the two people who are on this podcast, there's no big issues with desynchronization anyway, so I don't think it's a problem for them. But you have seen the odd Bitcoin fanatic who's had 10 times as much Bitcoin as they originally invested, and that has been causing some issues with other things like risk score as well, but that's another topic.
So the way things currently are, as soon as you start copying someone, you're automatically out of sync with them to some extent. The way things would be in the future is at least at the very start, you get started with exactly the same portfolio as they have on day one. Okay. Now then. to what extent does this affect the decision to copy open trades or not? There still exists the possibility that shortly after copying, a PI might close a position that represents a win for them but a loss for the copier. That's the key problem that people perceive with copying open trades. So that's not going away. But at least with the same percentage allocation, the interests are more aligned, it's fair to say. Again, no question at the end of that. That's a very good interview technique. Well, that was my next question. Was going to be, is there any downside other than what Neza has already articulated from her point of view? Are there any objective downsides?
At the moment, one of the advantages to Invested is that you can very accurately say your minimum copy amount. So if you haven't got any positions smaller than 0.5%, then you can be copied for 200. That's fact. That's a stable figure, unless you start buying and selling stuff, but that's a stable percentage. Under the new system, that's going to be a fluctuating percentage. So if you own your smallest position's 0.5%, you're copyable for 200. Then all of a sudden, that stock or that crypto crashes down to being 0.25%. So now all of a sudden, 200 is not going to copy all your trades anymore. But unless you're going to be updating your bio on a daily basis or a minute-to-minute basis, that minimum copy amount is constantly going to be in flux, and that could be an issue, especially if something like you've seen Russian stocks recently completely capitulate and are worth a fraction of a percent. Then theoretically speaking, you'd need thousands to copy you, because before it was based on the invested value, and now it isn't. And just incidentally, that's how eToro work their club tiers. When you've got the kind of platinum plus and diamond and all that stuff, is it's done by your originally invested capital. And the reason that eToro give is they don't want people pinging around between being gold, silver, platinum as your equity changes. They want it based on your originally invested equity. And I think it's the same with min copy amount. They probably like that stability of knowing what your min copy was, but that's going to be thrown out the window. So I think it could potentially be a problem, because shares can just go down rapidly without warning. So even if you think you're copyable for 200, a few weeks' time, that could just totally change.
Yeah, so in that case, those positions are going to be the smallest positions in your portfolio. So this means that for a person copying with $200, it's probably going to be a $1 or $2 position, which means that if there's a 10% rise in this cryptocurrency, then it's 10 cents. So I think I agree that it's a downside, but I think it's a very small downside, because as long as all the big positions and those are most of the positions, I guess, are almost the same, then I think it's a very small problem, because it's the very smallest positions of your portfolio that this affects. So in this case, I agree, but I just, when people talk about copying with like $200-300, then those are just extremely small investments, and it's not going to make a big change on the overall returns, in my opinion.
Here I have to agree with Christian. It is a downside, but I don't see it as that major negative point.
Okay, just come back on that. Is like, say if you had, was 0.5% was your smallest position and it was in a crypto, then that dropped to 0.49%. Someone copied you for 200, missed that position totally. This crypto then explodes 10x. So that 0.5% for you goes to 5%. They would miss that. Okay, that's an extreme scenario, but the positions at the bottom of your portfolio are more likely to be more speculative and can move around by potentially hundreds of a percent. Maybe they're leverage trades of some sort. So yeah, it is maybe a small impact, but it could still be important in some cases. It's more for people like me, I guess, who are obsessed with stats and detail and anally retentive. They'll be like saying, I've not got a perfectly synchronized portfolio, whereas at the moment, you're still not, but you can at least guarantee you're going to get all of the positions.
I'm reminded of a previous episode where we were talking about the minimum copy amount and how a lot of PIs aren't terribly clear what their minimum copy amount is, and the answers given are not terribly helpful. And I was suggesting that, well, surely that could be a data field somewhere that is presented to copiers. Like, we're telling you, the system tells us that this is how much is the minimum required to copy this PI. That's all the more important now if we're making this switch, that feature could could be part of it and just remove any doubt. And would probably alert a lot of PIs to, oh my goodness, look what this is saying. I better go check my portfolio and see why it's saying $10,000 is needed to copy me.
I agree. It's a good idea.
That's all I want to hear.
I've got a second problem as well. On a related note, is not only will your value be fluctuating, your risk score will be as well. Like, one of the advantages of the current one is you know roughly what your risk is going to be. Like, if you've got an invested amount of 10% in Bitcoin, for example, you know how that affects your risk, because the current value could go up to 50% Bitcoin. Your risk will still stay pretty much the same, because it'll be treating it as if you've got 10%. Whether that's right or wrong is another matter. But under the new system, your portfolio is going to be slaloming around on a daily basis. It's going to be far easier for your risk score to change, because it's going to be tracking in real time what your current value is, and speculative assets could get out of control. Whereas at the moment, you can see from the invested amount, you kind of know exactly how much exposure eToro risk score thinks you have to, for example, crypto or leverage trades, rather than how much exposure you actually do have. So that could be an issue. And it'd be interesting to know whether eToro plan to make the risk score being based on current value, which I presume they would, if that's going to be what people are actually copying.
You would imagine that would have to then have an expanded timescale. The risk score is not going to be continually measured on such a small time period, one would think. Now, okay, so we're talking about this whole issue, and I think I would say, despite what Neza has said, I would say the majority opinion, particularly among copiers, would be to embrace this as a positive, even though there are going to be a number of knock-on effects and it's going to make a few things tricky. I wonder why it was not set up this way. Anyone, any ideas why it was created with the invested column in mind?
I'm not exactly sure, but I think eToro started more like a trading platform. You were like trading Forex and trading indices and so on. And if it somehow makes more sense to use the invested amount there, I'm not sure, but eToro has developed very much over the years. So now it's mainly like, I would say there are more long-term investors these days and more stock investors these days. And I guess that if you're a trader, then it's not as a big of a problem, because you only hold positions for a short time probably. And if it's better in some way, I'm not really sure, but I think it's somehow related to the change that eToro has had over the years, changing as a platform.
I've got an idea as why it might be done the way it is at the moment, eToro captures risk and indeed other things like performance as a daily snapshot. And it's far easier to take a snapshot of a static figure. Like at the moment, say Neza has HDV, his highest position, 5.03%. You can take a snapshot of that, a risk snapshot, whereas the current value is all over the place, and that maybe would be harder to take a snapshot of. I'm not sure, because I don't have any IT background as to the technicalities behind that, but I imagine it's easier to take a snapshot of a static figure than one that's moving second by second, sometimes by a lot if it's something like crypto.
Coming up in part 3, will this conversation ever pay dividends?
Do you copy?
Do you copy?
Do you copy?
Do you copy?
Copytraders Club.
Copytraders Club.
Do you copy?
Do you copy?
Do you copy?
Do you copy?
Copytraders Club.
Copytraders Club.
Part 3, will this conversation ever pay dividends? I'm sure that's the question you're asking yourself, listener. There are more PIs with the word dividend in their username than any other word. I don't know if that's true, but it sounds good. At a time when there seems to be no safe haven for investing your money, suddenly dividends seem like an amazing idea. Free money regardless of how the stock price changes. So we're going to consider the whole issue of dividends in the context of eToro and copy trading, but also dividends in general. So I'd like to start with the very basics, so every listener comes along with us in this chat. Maybe Christian, could you talk us through some dividends basics? 4 quick points. What is a dividend? Where does the money come from? What benefit is there to a company in giving away money? And what else could the company do with that money?
Yeah, so first of all, what is a dividend? So a dividend is something that a company pays out of their profits, and it can be or usually is a quarterly paid, or can be a quarterly paid dividend. So you get paid as an investor, let's say every quarter, to own a stock. And usually there's a dividend percentage that is given that you can find when you study the stock. To say it in a very basic way, like if I buy a company for $100 and it pays out a 2% dividends, then I get $2 as a payment. I think one thing that many people don't realize is that usually the stock goes down by 2% as well, and this is usually masked by the noise in the markets, but it's really a fact. So you see a lot of people talking about, like, if you copy me now, you can get a dividend in a few days. And then let's say you have made this investment of $100 in one stock, and you get out the dividend payment of $2. Then what you're going to have, if you have this dividend payment immediately, you're going to have $19 in the stock and $2 in cash. So this is what you had. Basically, you got your own money back.
Okay, well, we're going to get into that, but you've strayed a little bit from the very basics. Points 3 and 4, what benefit is there to a company in giving away money? And number 4, what else could that company do with the money? Can we address both those?
Yeah, I mean, for me, it's like you need to think about what to do with the profit as a company, and you can do many things. You can pay them out as a dividend, or you can invest them in your business, and you can also buy back your own shares as a company. And I guess those are the 3 main uses. You can also acquire other companies. So these are the options that you have as a company. Personally, I'm not a dividend person, like in the sense, like, I try to avoid dividends because it doesn't make much sense for me to take out the gains every year, because I have to pay taxes on the dividends. I really prefer companies that actually reinvest their money into their own business, because I think that usually if it's a growing company, they would know better what to do with it. So using one of the other options is usually the companies that I prefer.
Well, I would say for a lot of investors and a lot of PIs, it doesn't hurt to have a few dividend payers in the portfolio. That seems to be the general opinion. Especially in this market, I think the emphasis on dividends has been turned up probably a little too high.
Yeah, I agree. I mean, it's a stable source of cash or income to your portfolio, and especially during this time where you are having kind of, I would call it a bearish market, when most things just go down, then it can be a stabilizing factor in your portfolio. And certainly, if you look at the performance of those stocks this year, it has been better than almost anything else, because there's usually utility companies that pays out dividends, or it could be energy stocks and so on. Maybe some biotech stocks paying out dividends as well. And I mean, also IT companies do it. So this year they have been performing very well. I think if you look at a longer horizon, you will see that they are very stable companies, but they're not necessarily the ones that will be the high performers in a long time horizons. And for me, it's just a disadvantage because of the tax system in my country, and I think it may be similar in a lot of other European companies, to take out some of the winnings, because I have to pay tax on that. And it actually a little bit ruins the compound interest that I could have by keeping the cash in my portfolio and then compounding that over time. So I don't like to get the money out. I don't want to use the money now. I want to reinvest the money in any case. So if you have a long time horizon as an investor, like 10 to 15 years, I wouldn't be having too many dividend paying companies, but I have some myself. So I think that the main point is really to find the right companies, and then later you will have to find out, do they pay a dividend or not? But if I have 2 companies that would be exactly the same, and one paid dividend and one didn't pay dividend, I would usually choose the non-paying dividend stock, because I have to pay taxes. And also, I think that it tells you something about the company that they don't necessarily know what other things to do with the cash. I really prefer them to invest it in their own business.
Neza, would you go along with that, or are you a bit more positively disposed towards the receipt of dividends?
I'm more positively disposed to dividends. My portfolio consists of quite a few companies that are paying out dividends. And especially, like Christian said, in this bearish market, I think that it's nice to have some of money coming back from company through dividends, but not everything that company makes goes to dividends. I like that companies are also buying back their shares, that they're effectively using that money. Dividends are not the only metric, but yeah, I like them in those times, and they're a good sign for me, especially if companies have a long and stable paying out dividends, long history of them.
Do we all agree that this is something that resonates with copiers? Copiers like the idea, I get the impression, of getting some of their money back, regardless of the vicissitudes of the market to some extent. You find your copiers, Neza, are very keen on that as an aspect of their experience of copying you.
Yeah, I inform them whenever my portfolio have some company that is ex-dividend or is paying out dividends. For example, BHP that went minus 8% last week because of their ex-dividend date. So I wanted to explain to them why this happened. And I think that, yeah, they like to get some of their money, but it's not the main reason. At least I think so.
Yeah, that was great to hear kind of two sides of the coin. And I've actually released a video today as we're recording this. So it'll be a few days before this conversation is released. And the video is called eToro Dividend Theory Explored. And it really covers a lot of things that Christian led off with, but also the advantages that Neza had talked about. And yeah, there's something called dividend irrelevance theory, which a PI called Wojciech Poznański has made a great post on recently, and that kind of inspired my video in many ways. And the kind of argument there is what Christian was saying is dividends don't actually affect the company's share price, because for every dollar you pay out, share price will drop by that. No value is being created at all, so dividends are irrelevant in the long term. Whereas there's counter arguments to that the market isn't efficient, and if a company pays a dividend, people are more likely, it's going to be a higher demand for that company, and that will push its share price up, possibly in the same way that stock split theoretically shouldn't make any difference, but in reality it does, because of the psychology of investors. And as Neza was talking about, even just from a copier's point of view, it can be reassuring to have cash coming in. So I'm kind of more on Christian's side in terms of I don't really want dividends on eToro to be paid. There's reasons for that to do with tax. I'll gladly go into later on, and how eToro specifically, it doesn't apply the right rate of withholding tax. But generally speaking, yeah, if I'm holding for the long term, given that dividends are irrelevant, then I'd rather not have the hassle of getting them and then having to put them back in again. And also the type of companies that pay dividends are generally more slow growth companies, like your IBMs and your AT&T and Coca-Cola. And in some cases, they're not really innovative companies, whereas the companies that don't pay dividends are often, like Google would spring to mind, Amazon. They're really deploying that capital in what I would consider an optimal way. But I can see both sides of the equation on that one.
Yeah, in an environment where nothing is growing, why not pocket a few dividends would be the point of view.
Oh, an environment where nothing's growing, share prices probably are going down. Therefore, companies that don't pay a dividend could be buying back their own shares at a cheaper price rather than paying out dividends, which, as I understand it, isn't tax efficient for the companies. And it sure as hell isn't tax efficient for me as an eToro client if I'm losing 30% of that dividend, when I should actually only be losing 15% of it if the tax treaty was applied properly.
Now, in terms of PIs who publicize their dividends. I'm sure you've got a few things to say about that, Andrew, and the way that that information is imparted. One could argue that every PI has a fiduciary duty to some extent to their copiers who might be not high information actors. So that the information imparted about dividends has to be very accurate. And as we all know, FelixFallax's eagle eye is always peering from a couple of 1,000 feet to see who's being inaccurate. So,
Okay.
Andrew, tell us about what gets your goat in this area.
Yeah, well, I think there's kind of four main categories, and I explain it in the eToro dividend theory video, but that's more theoretical. The one before that, called the eToro Spammers Playbook, kind of shows you some of the tricks, but they fall into four categories. Like, one is kind of this dodging of the issue that Christian highlighted of dividends don't actually create value. Some PIs tend to make out that this is free money you're getting that's been shaken out of the magic money tree that's additional, but it isn't really. It's not actually affecting the value of your portfolio. It's just moving it from one place to another. So that's not always made clear enough, because it's a good marketing technique to say you're getting free money. Secondly, the effect of taxes. PIs will often quote you the figure before tax, when in reality, everyone with US stocks on eToro is losing 30% of that, which is a hefty amount. And it doesn't also take into account that eToro isn't tax shielded. So you've got your local tax as well. Like in the UK, the dividend tax is £2,000. The threshold is £2,000. So anything over that, you pay tax on it. Whereas capital gains tax is over £12,000 before you start paying tax. So there's the tax aspect, which you generally won't see PIs addressing. Thirdly, is the methodology for measuring returns. You see people talking about dividend growth rather than dividend yield. And in some cases, when pressed, actually quote a figure and say that they've got 10%, which is actually their dividend growth, not their dividend yield. I've seen people talking about yield on cost, which is comparing the current dividend to the price they originally paid for the stock, which that's not going to do copiers any good, because if they're copying now, the yield's based on what they're getting now, not what the PI paid 5 years ago. And also, I'm sure I've seen some people doing the sneaky tactic of arithmetic averages, whereas if they've got some stocks that pay a 7% dividend and a much larger amount of stocks that pay a 3% dividend, they'll say their average dividend yield is 5%, when it clearly isn't. There's far more of the ones that pay a low dividend. I've seen people with Googles and Amazons and stuff at the top of their portfolio, and they've said their portfolio is yielding 8%. I'm simply not believing it. If you look at the weightings of the stocks. And lastly, the biggest kind of lie, I guess, that's sold is the emphasis on you can retire on your dividends. But I did a calculation in this recent video of mine, and really to earn an average UK salary of £31,000, which is about $35,000, you would need to have a portfolio of well over $1 million if you take into account the taxes that come off there to even pay yourself an average wage. So I don't think anyone on eToro, or very few, are going to be retiring on dividend income. And if they were, I wouldn't be having it in eToro. Obviously, I love eToro, but in terms of dividends, I would be having it in a tax shielded account like an ISA or a Roth IRA if it was America, not in a site like eToro, which is completely unshielded from tax and indeed charges the wrong rate of withholding tax. So that's the four marketing techniques that I see. These issues are all body swerved and fudged very often by dividend PIs.
No, I agree. I didn't study this as much in detail as Andrew did, but I'm just seeing those dividend updates, and I guess especially I think it was the first point that Andrew mentions, which is like you get the idea that you just get like free money, free payments, and especially like if you start copying me now, then you can get payments already in 3 days from now, ignoring the fact that you're actually getting back your own money in this case. So I think it's difficult for new people to decipher this because none of these people are explaining. And I think it's really good what Neza is doing, like explaining what is happening with the ex-dividend date and so on, and why did the stock drop and so, because that's educating people. So I think that's also an argument for improving the feed, actually, as we talked about earlier. So you would make sure that those quality posts would get more exposure, as I think Neza's post would probably get much more likes than the other posts. So we would see more of the hopefully quality content if this change, this algorithmic change was made. So the problem is with social networks, you can easily spread misinformation. We see this on Facebook as well. It's actually probably one of the biggest drawbacks of Facebook and of social media, which is that anyone can post anything and you don't really have police force governing everything. You cannot really control everything or fact check everything because it's just too difficult to do. And that's the drawdown of social media that I think eToro also has here. And it's not easy to find an easy way to respond to that. But I think perhaps like if there are posts that has this like wrong way of putting things, maybe more people should report them. Not only spammy posts, but also posts that are obviously giving a wrong portrait of how dividends work. Then I think you should probably just report those posts. And then I hope that eToro can be more maybe react more faster sometimes on getting those posts deleted if they're not like portraying a good picture of how things work.
Here we saw two different perspectives on dividends, and I don't think that neither of them is wrong. I like them, Christian doesn't like them, and it's good to see different PIs with different strategies so everyone can find someone to copy. I think that we all agree on this point that problem is in this misguiding posts about dividends and about how they're free money and so on. Because I think that if you explain copiers why is something happening and what is going on, this actually makes a difference.
Yeah, I think maybe it sounded a bit too... maybe I sounded a bit too tough on dividends because, obviously they have been performing very well this year and also has a stabilizing factor in portfolios. So I would say probably, especially in the market sentiment we have now, I think it's a brilliant thing to have. But also because of some of those companies of the sectors they're in, like the utility sector and the energy sector are performing very well now. And I think probably for the rest of the year, maybe performing better than many other sectors, and for this reason, maybe I sounded like I'm a little bit too much against it. It's like I do have dividend-paying companies in my portfolio, so I think I just like to focus more on the company than on the dividend. So just trying to find the right companies, and then sometimes they pay a dividend and sometimes not. I personally prefer a little bit if they don't do it, but I do have those companies in my portfolio as well.
Yeah, if I could just add to that, I think psychology is important in investing. The same way that drawdown can be psychologically difficult, but can actually provide greater returns. Receiving a dividend can be really reassuring because it does reduce volatility. So in that sense, it has got a value outside of what it adds to your portfolio. And another thing is, Christian makes a good point about companies that are doing well this year happen to pay dividends, but I think the reason why they're doing well is not so much because of the dividend, it's because they're in sectors that are making high profits, like oil or electricity. At one point to make as well is that dividends actually used to have, I would argue, a far more useful role before commission-free trading and non-fractional shares. You used to, if you wanted to take some money out of the value of a company, you'd have to sell the whole share and pay a big commission. Whereas nowadays you can actually, even if you've got growth stock like Amazon, you can sell 1% of your Amazon shares with no commission, no fees, and you can take a dividend for yourself out of a growth stock, whereas previously you couldn't do that. So dividends were a fantastic way of getting paid without having to incur the charges of selling your stock. So I would argue that dividends have lost a bit of their usefulness. 10 to 20 years ago, dividends were an incredible way to get an income without incurring huge charges for selling your stocks.
Actually, Warren Buffett made this calculation, I think it was 10 years ago, where he compared like a sell-off strategy where you would sell like a little bit more than 3% of your stocks every year and comparing this to the dividend and made this calculation. His company is not paying out dividends. And I think you may want to, if you're very interested in this topic, you could investigate why that is. But it's certainly because of some of the points that we've been discussing here today. So I think that's interesting, and I think it was like in the 2012 Berkshire Hathaway forum where he was making this calculation, and I think it's something interesting for people that want to dive a little bit deeper into this to go and check that out and his argumentation for that.
Okay, there's a little bit of further research for the most proactive listener, and I think that just about does it for us here today. I think we've given the dirty laundry a good public airing. On behalf of the grateful listener, for whom listening has surely paid rich dividends. A big thank you to Neza.
Thank you. Thank you for inviting me again.
Christian.
Thanks for having me.
And Andrew.
Thanks for having me on the show, and great to meet Christian and Neza today.
I don't know about you, listener, but I found that to be a most enjoyable chat with some surprising and differing views and a few very insightful moments. All due, of course, to the quality of our panel, to each of whom we are eternally grateful. That's all from me. See you on Discord and Facebook. Until next time we meet at Copytraders Club, I wish you many happy returns. Obviously, anything you hear in this podcast is for entertainment only, not financial advice. Do your own research. It's just generic chit-chat. We don't know your individual circumstances, etc., and so forth.